I am Jeremiah Ajuda Dusu, the author of Jad's Business and Financial Accounting. Okay, good to see you again today. All right. We are actually trying to, get some insights, okay, on foreign subsidiaries. That's group balance sheet as well, okay. So we have groups who can consolidated balance sheet. Okay, we're looking at exchange difference and movement in reserve. Okay. Um, of course, I believe at this level you understand the translation. Of course, we're trying to, you know, reinstate a balance sheet in a foreign currency into the currency of the reporting entity, right? Okay. So you understand that aspect. Of course, you agree with me that as a result of the fact that the exchange rate is not stable, of course, various factors, demand and supply, consumption patterns of the affected environment or the economy and all that. So these do not make the exchange rate to be stable. So you can have an exchange rate fluctuate over a particular period of time, right? So basically, if we have the exchange rate, um, let's say we have 80 kobo to let's say one sefa or one F sefa. Okay, so if this is let's say 1st of January 2016, it is possible that by the time it gets to 31st December 2016, it might have gone to maybe 0.85 kobo to one sefa. So you can see that there's a fluctuation from 8 kobo to 85 kobo. Okay, so this is a difference now. Of course, you can see there's a 5 kobo difference there. Okay, so as a result of the translation from a foreign currency to that of the reporting entity, okay, there can be an exchange difference. Now that exchange difference can be a gain or a loss. Okay, so usually in a single entity, okay, where there is a sort of should I say appreciation, okay, in an investment, okay, in a foreign currency, okay, we say that there's a gain, but where there is a depreciation, we say there's a loss. So if, for instance, at the beginning of the period, let's say you invested 80 kobo, all right, so 80 kobo to one sefa, what you invested is here. By the time you're reporting at 2016, you're now having it to be 85 kobo to one sefa. Okay, so what it simply means there is that if you bought at 80 kobo, you're not trying to what sell at 85 kobo, there is what a gain of 5 kobo. But if in this same date it is now 0.70 kobo to what? To the seller, and you bought at 80 kobo, you're saying at 70 kobo, that means there's a loss. Single entity. Okay? But now we're looking at it from what? A consolidation what? Perspective. So it means that we have a translation happening. So what are we translating? Our balance sheet. So we have a balance sheet. We have a balance sheet. Okay, so the balance sheet, of course, you have assets, and then you have what? Liabilities. So you know your asset items, right? So let's focus here. So we have, you can have what? Of course, you can have loan, you can have payables as usual, right? And then you have share capital, and then you have reserve. Your reserve, it's pre and what? Post. I only believe you understand that at this level. Okay, so for group accounting purpose, we already agreed that our net asset acquired is a function of what? Share capital and what? Reserve. Right? So now I want to know, after translation, say we have CEFA. Okay? Let's say share capital here is 100. Pre, let's say it is 50. Post, let's call it 70. So that means our net asset acquired is 100, 150, this will be 220. Right? Now, by the time you're translating, of course, we have a rate. Let's say, of course, for closing rates, we use, of course, we use the rate at the date of acquisition for what? Share capital and reserve. So let's say the rate as at date of what? Acquisition for share, let's say it is what? 70 kobo. So let's say this one here, of course, will be 70 kobo. Of course, then this will be balancing, right? I thought this already. So this guy here is it should be 70 naira. 70 kobo times 50. They're not 25. 35 naira. Then this will be balancing. So let's say the total asset here, let's say is 200 naira. Total asset here, let's say is 200 naira. Then, of course, you have your loan items, right? And then you have your payable items. Let's even call this 300. So let's say translated loan is 50, payable is 50. So we have 100, 170 plus 35. What do you have there? That should be 205. Well, let's check. $205. So if we do 300 minus 205, what do we have? $95. So balancing here will be 95. So that you have your translated what? 300. You have rate here. So this will be naira. So at this level, This is the share capital, or this is what we call net asset acquired, right? And then we have translated, okay? But now, there is a rate, for this is as at the end of the period, 31st December, let's say 2016. Now remember, there is a rate ruling at the beginning of this period, which is 1st December 2016 or 31st December 2015. Now this net asset acquired, you want to know what is the rate of this net asset acquired at the beginning of this period. Okay? So if you are trying to get the net asset acquired at the beginning of the period, it means that, of course, your share capital will qualify 100. Pre-acquisition reserve, that's at the beginning too, it will qualify 50. But this 70, which is post, has retained earnings. Of course, there's a retained earnings in the period. There's a retained earnings in the period. Of course, if you have something if you have something reported at the end of the year, there must be a beginning balance. So this is it's part of it. So you want to know what is, the opening balance as of 2016. Now you have established that 150 will be part of it. Now, which is for the current year. So you want to know the retained earnings out of this reserve that is for the current year. So let's assume that for the current year, 2016, the retained earnings, let's assume it is what? 30 CFA. So that means that if you take 30 out of the 40 will qualify as opening what? Net asset acquired. So we now have 150, that will be 190 opening net asset what? Acquired. So if we have opening net asset acquired to be 190, we're trying to get the exchange difference now. If the opening net acquired is 190, opening net asset acquired, okay, that would be what? 190 times the rates ruling as at the beginning of the period. What's ruling as at 1st 2016 or 2015? So the beginning rate, let's assume beginning rate is what? 0.8. So what would this give to us? 190 times 0.8. So that would be 152. This is for the beginning. Now, the retained earning for the year, which is 30 CFA. What is the translation? Of course, you'll have gotten that in translating the profit and loss account or the income statement, but we've not started doing income statement yet, okay? When we get there, you will understand. But then, understand that there will be a translation from the income statement as well. So you want to know the retained earnings. What is the translated value for the retained earnings? So let's say the 30 CFA was translated as 3,000. So that means you're translated, let's say as 80. So that means translated retained earnings is 80. So we now have 2. 8 plus 5, I think is 13. 230. So this is the expected translation. This is what we expect the translation to be, taking into consideration the opening net asset acquired and the what? Retained earning translated. So this is the expectation. So, but we'll now ask ourselves, what was the actual translation done? So we'll now come back to the balance sheet here. This is the actual translation. This this and what? This. 735.95. So let's add it. Sorry, 70.35.95. 70 plus 35 plus 95. 200. So that means translation or translated balance sheet is giving us what? 200. So the difference is what? 32. Well, you can see here that it is a positive difference. Of course, net asset acquired is a credit balance. So if you're increasing it, it means there's a credit. That's a gain. Okay? So if this is what has been done, but this is what we expected, that means there should be what? An increase. Right? So that means for it to come up now, okay, from this angle is correct, but from this angle, it has to come down to what? 200. So that means that what? If you now have to say net asset, what I would say credit now, you want to what? Okay, bring it down. That will be that's what? A loss. So in a nutshell, if the resultant what difference is a positive sign, it's what? A loss. If it's a negative sign, then it's what? A gain. So in this scenario now, you can see that it's a positive sign. So this is what? An exchange loss. Okay? Now for the what? Share of this what? Loss, the holding company will take its what? Share. So the holding company have, let's say, 60%. So the holding company's what? Share. You can call it the group share or the holding company share. That will be what? 60% of what? 32. So what do you have? 0.6 times 32. That's 19.2. 19.2. That's the exchange rate. So in a nutshell, what we're just trying to look here is that for exchange difference, we want to know the expected translation and the actual translation. What's the difference? The difference can that be a gain or what? A loss. Okay? So that is for the exchange difference. Then we have what we call movement in reserve. Movement in reserve. Movement in reserve is simply, the effect on the reserve position of the group after absorbing goodwill on consolidation, after absorbing exchange what gain or exchange loss, and also after absorbing its share of the retained what earnings of what the subsidiary for the period. So it's about what? Plus and what? Minus. So we can say a statement of movement in what? Reserve is simply your what? A function of what? The group's reserve, the goodwill on consolidation, percentage retained what? Earnings, exchange what? Gain or what? Loss. So depending on the position of positive or negative, when you add up, whatever you get is your what? Is your CP and what? L. So this should agree with your CP and L that transfer to the what? To the balance sheet. Okay? So it's a straightforward thing. Okay, so you take your time, go through it. If you have questions, you can reach my number as displayed. I'm just replying your answer. So let's take a question so you understand what we're talking about. Okay? No rushing, huh? All right. Okay, let's quickly take this question so you have an idea of what we're talking about here, okay? So we have the following represents the balance sheet of Kings PLC and Queens PLC as at 2018. We have Kings, Queens, non-current assets, current assets, investment in coins, non-current liabilities, current liabilities, share capital, and reserve. Okay, so they say at the end of commission, Kings Nigeria PLC acquired 90% shares in Queens Ghana PLC on the 31st of 2016 when its reserve was 20,000 Ghanaian cedis. So Kings PLC uses the closing rate method of translation. Kings PLC writes off any goodwill on consolidation mainly against its reserve. And I say the retained profit of Queens PLC for the year 2018 is 30 Ghanaian cedis translated to 1,500,000. The following represent the exchange rate of relevant years. You are required to prepare the reinstated or translated balance sheet, consolidation schedule, statement of exchange difference, statement of movement in reserve, consolidated statement of financial position as 2019. So let's go there. Okay. So this is just something that we should quickly play with. So the first thing there, we have reinstatements of what? Of balance sheet. Okay, so let's go. We're going to have assets. Because it's 31st December 2018. So what are the assets there? We have non-current assets. We have current assets. We have investment in coin. So of course this will be coins, Ghanaian city. We're going to have rate here. So what's the? We have 250. We have 150. Going here. Okay. So this is giving us 400. So what's the liabilities? So non-current liabilities. We have current liabilities, share capital, then we have reserve. So what's non-current? We have 90. Current liabilities, we have 50. Share capital, we have 180. Reserve, we have 80. Okay, so we add up, we're going to have what? 400. But remember, this will go into pre and post. So what's the pre element? So when they said King's PLC acquired event, that was 20 Ghanaian cedis. So pre here will be 20. So post to be what? 60. So we have 90, 50, 180, 20, 60. Okay, so what's the rate? They said the business uses closing rate method to translate, which means we're translating, okay, at what the rate ruling as at the balance sheet date, but the share capital and reserve we use what? The historical review date of acquisition, right? Good. So we have the rates here, and the first 2018 is 44 naira per day. So we have 44, we have 44. This will be 44 as well. This will be 44. Share capital, that as at the date of acquisition, what do we have? Acquisition in 2016, that's 32. So this will be what? 32. This will be balancing. So let's go. 250 times 44. 11,000. So this will be queens. This will be naira. This is 11,000 here. 150 times 44. 6,600. So what do we have here? This should be 17,600. So what's this? 90 times 44. 3,960. 50 times 44. 2,200. Share capital 180 times 32. 5,760. 20 times 32. 640. So what's the balancing figure there? We have 3,960 plus 2,200 plus 5,760 plus 640, 12,560. So we'll say 17,600 minus 12,560, 5,040. So that this will give you 17,600. Okay, so we have 17,600. So this is the restated balance sheet. I call it the translated balance sheet, right? Okay. So let's proceed. So the next one, I said we should prepare the consolidation schedule. So we're going to have, let's have that here. Okay, so we have cost of control, annualized interest, CP and L. Okay. So here, I think it's 90%, 10%. So this is kings and queens. So let's go. We have queens, share capital. Here is 5,760. 5,760. So we have 90% to kings. $5,184. 10%, I think it's 576. So we have the reserve. So what's the reserve here? The reserve will be this. This is 5,680. So we have 5. Let's see, 5,680. Pre-post. Pre is 640. Post is 5,040. Okay. So this will be times 0.9 times 0.9 times 0.1. So 640 times 0.9, 576. This is 568. Okay, so we have 10% of 5680. So we have 9% of 5040. 4536. Okay, so let's go. We have net asset acquired as this 5184 plus 576. $5,760. Okay, so cost of investment. What's the cost of investment? $9,000. We have 9,000. This comes off. What do we have? 5,760 minus 9,000. 3,240. So this is the goodwill. It says we should transfer immediately to the reserve according to policy. So we have, let's transfer 3,240. 3,240 is negative here. This is dash. We have minority interests. 576 plus 568. 1144. So what's the King's Reserve? King's Reserve here, 2,800. So C, P, and L is 4,536. Okay, minus 3,240 plus 2,800. 4,096. Okay, this is the schedule. What's the next in there? Next requirement that says statement of exchange difference. Statement of exchange difference. So let's go. Let's do that here. Exchange difference. So let's go. So we say net asset acquired at start. So of course this is 2018. So what are the opening? Of course we know that net asset acquired is what? Share capital and reserve, right? So what are the opening share capital? Share capital is 180. Of course you know that share capital, so long as it is what it is at the beginning, or from date of inception, or from date of acquisition, so there's an issue of shares, it remains, right? Good. So we have 180 plus, what's the reserve at the beginning of the year? Of course, this is pre. You should go. So this 60 is post. So what is the retained the retained profit for 2018. But we're looking for beginning. We're not looking for the end of 2018. We're looking for beginning. So we have to get one that is retained. That is the one that's related to the 2018. So that will help us get the beginning. So how much it has been retained for 2018? According to the question, they said that the retained profit of Queen's PLC for the year 2018 is 30,000 cedis. So of course that will be plus 30. So that means, excuse me please, this is 180 plus 20. 30 has been retained. So if we take 30 out of 60, okay, it will be remaining 60. So the 30 retained is for the year. The one that is remaining will form part of the beginning of the year. Okay, so I've explained now. So we have 30. So 180 plus 20 plus 30, that should give us 230 times what is the opening rate? What's the opening rate? The opening rate, that is the rate at the beginning of the year. So beginning of the year is 1st January 2018 or 31st January 2017. So we have 2017 December here to be 34. So we have times 34, right? This ORS, opening rate, just for notes, okay? So what would that give to us? 230 times 34. $7,820. Now the retained profit, which is 30, what is the translated amount in the word P&L? Of course, if you translated balance sheet, that translated the word P&L. Of course, we are not doing P&L yet, but that's how it works. So what is the translated? So the information should be given. So they said that what? The 30 Ghanaian cedis translated to be 1.5 million. So translated retained earning is 1,500. So when this comes in, we have 0, 2, 8 plus 5, I think that's 13. So we have 9320. This is the expected translation. 7,820, okay, plus 1,500, 7,320. Now, what was the actual translation? So, actual translation, that is what we have here: 5,760, 640, and 5,040. What do you have? 5,760 plus 640 plus 5,040, 11,440. 11,440. Okay, so let's put that here. 5,760 plus 640 plus 5,040. 11,440. What's the difference? 9,320 minus 11,440. $2,120. That's negative. It's a gain. $2,120. That's exchange gain. Then what is the word? Holding company's percentage of the gain. That is 0.9 times 2,120. $1,908. 1,908. Okay. So that's it for the exchange gain. So what's the next one? statement of movement in reserve. Okay, before we do that, we must understand, okay, what we call the post-acquisition element of the opening what net asset was acquired. Okay, the post-acquisition element of the what opening net asset was acquired. So what do we have? So we say retranslation of what? Opening net asset acquired. Okay? So what opening net asset acquired now? We have 230. So we have net asset acquired, that's 230. It's broken down into what? Share capital of what? 180. We have pre of what? 20. Right? Then post is what? 30. So it gives us 230. So this guy will be at the what? Opening rates, which is what? 34. So what does that give us? 230 times 34. That's 7,820. Then this guy, we've done 32. We've done 32. This one will be balancing. So 180 times 32. Five 760. This will be 640. Balancing. That will be 7,820. Okay. Plus 640. No. 5,760 rather. 5,760 plus 640. That's 6,400. So we say 7,820 minus 6,400. That's 1,420. If you add this 5,760, 640, 1,420. $7,820. So what we've done here is to what? Retranslate the opening what? Net assets what? Acquired. Okay? So we have the opening post-acquisition what? Reserve. Okay? Now, since we've gotten what this, we need this. We need the post what? Acquisition percentage. Okay? To compute the movement in what? In reserve. Alright, so let's go. So we have statement of what? Movement in reserve is about plus or minus, eh? Okay. So we'll go. Now we have parent companies what? Reserve, or we can say group reserve. I think we have that here, 2800. So what's our goodwill on consolidation? We have that 3240. Okay. So what do we have now? What's our group share of opening post-acquisition reserve? Now is 0.9 times 1420. What do we have? $1,278. Okay, so what's our exchange gain? Exchange gain here is 1908. Then what about the percentage of what? The group's retained earnings. So what's the group retained earnings? Sorry, the subsidiaries retained earnings rather. According to the question, the subsidiary retained earnings is, that's translated 1.5 million. So we have group share of what? Retained earnings. And that is 0.9 times 1,500. What do we have? $1,350. So let's go. 2,800 plus 3,240 plus 1,278 plus 1,908 plus 1,350. Don't forget that the 3,240 is negative. So make sure you know what you're doing. 4096. So this is what reserve as per what group balance sheet or consolidated balance sheet. If you look at this place, it should tally. So the next one now is to prepare the consolidated statement of financial. So we say Kings and its what? Subsidiary. Consolidated statements of financial position. As at 1st December 2018. What? Assets. So where we have non-current, let's call that note 1. Let's put note 1 here. Non-current, that will be what? Queens 11,000 plus Kings. How much is Kings own? Kings is 800. So we have 11,000 plus 800. So what do you have? 11,800. So we have current. Note 2. We have 6,600 plus what is Queen's own? So the King's own here, current asset is 800 as well. So what the other to be 7,400. Let's check. $7,400. Is 2, this will be 9, 29,200. So liabilities, non-current liabilities. Let's go down to 3. What do you have? 3,960 plus that of Kings is 3,200. So what do you have? 3,960 plus 3,200. $7,160. Current in 4. $2,200 plus Kings 1,100. That should be 3,300. So what our reserve? Could be this, it could be this. 4096. Share capital. Share capital is 3,500. Minority interest 1,144. What do we have? So 7,160 plus 3,300 plus 4,096 plus 3,500 plus 1,144. We have 19,200. Sorry, this is 19,200. So we have total assets, total liabilities. So what we've done here is what we've already been doing, but here we tried, showing exchange difference and what movement in reserve. Okay, so take your time, go through it. If you have questions, you can reach me on the numbers displayed. I'll be able to reply with the right answers. Don't forget, you can support us by printing account numbers displayed. Sponsor copies of my textbook for free distribution to students. See you next class. Bye bye.